Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage, I tell.
All right. Hey, everybody. It's Mark Eitel, and you are listening to the Mr. Mortgage Show. Guys, we are so very excited to be with you today as we wrap up 2023 and we do the 2023 Year in Review show. Guys, can you believe we made it through 2023? My God, what a crazy year in real estate it was. We saw interest rate hikes. We saw mortgage rates go from the 6s to over the 8% mark, which a lot of people predicted for the second year in a row that it was going to crash the market. Well, not so fast. Lucy, you got some explaining to do. Guys, we've talked about it for years and years. It's supply and demand, not the cost of capital, and yet another year proved that. And a lot of the predictors and tea leaf readers and crystal ball readers were wrong yet another year in a row. Guys, don't forget that in 2022, they predicted a market crash because we had seen an 8% interest rate for a minute in 2022. We pulled back. And here we go, the ultimate mulligan. A lot of people don't realize this, but here we go with another January with rates in the mid-6s. Guys, this is where we started 2023. We're almost identical to where we started 2023. So interesting that it's, as I mentioned, the ultimate mulligan, Groundhog Day. Wipe 2023 off the map with the exception of the appreciation, and things look pretty darn similar. Although I have to say, the big difference going into 2024 from 2023 is that almost all of the economists and forecasters are anticipating appreciation, where last year that wasn't the case. A lot of doomsdayers and market predictions around a crash. And I think finally people are getting it through their heads because, as I mentioned, we've talked about it for years. It is supply and demand. And even in those blips of 8% interest rate environment, there was still enough demand to absorb the supply and not put downward pressure on pricing. Now, here's something you may find interesting. A lot of people are forecasting an increase in demand as money becomes more affordable because the payment on a 6% mortgage versus an 8% mortgage is wildly different. Guys, at 6%, a $320,000 mortgage is going to cost you $1,918. And at 8%, that same mortgage amount is $2,348. So a difference of over $400 just by lowering the interest rate. And that's why we've been encouraging people throughout this entire cycle to use a rate buy down, oftentimes with a seller contribution if that's available, to buy your rate down permanently, although a lot of people use the 3-2-1 buy downs, and now might be a good opportunity to get yourself out of those. And we can talk about it this week if you have questions around that, refinancing a 3-2-1 or 2-1 buy down mortgage. But my point is that lowering the interest rate instead of lowering the price can save you significantly more each month and increase your buying power. Because fun fact, guys, we don't care about the home price. We don't care about the interest rate. When we are doing an approval of a mortgage, it's only based on the budget. How much money do you make and how much money do you spend? And in all of that, debt to income ratio calculations determines how much you can borrow. Now, the interest rate clearly dictates how much you can borrow, but that payment is the only constant. And you can see, for example, keeping the purchase price the same, but lowering the rate can save you $400 or more in that last example, or keeping the payment the same, lowering the rate can also increase your purchase price. So lots of variables around a falling interest rate environment. And that's why a lot of the forecasters anticipate a bump up in activity. And we've seen some sellers take advantage of that by jumping into the market. We're up with listing inventory. However, we're down about 38% from pre-pandemic norms. And you'll hear that term a lot going into 2024, pre-pandemic norm, because that's the last normal real estate market that we had was right before the pandemic, because this COVID era real estate market, nobody has been able to get their mind around where we're going, but we can look at where we've come from for some guidance. So one of the things I'm super encouraged by as we hit 8% the second time in about a 12-month period was it definitely proved the market resiliency and the supply and demand being the only thing controlling values. And we've talked about that ad nauseum, and I'm happy to dive into that. I geek out on that. I love talking about it. But here's something. There's a little concern in the market that we're going to see an appreciation bump in the spring, because if suddenly more buyers come out of the woodwork because rates are in the sixes, I don't know that suddenly a lot of sellers are going to come out of the woodwork because rates are in the sixes. Because on the way up, that 5.5% or 6% interest rate threshold seemed to be where the inventory valve was shut off, meaning a lot of people were content to sit and just ride it out and love the home they're in. And they may not love it from the standpoint that it has all the bells and whistles, but they love that interest rate and the subsequent mortgage payment. Well, if 6% became the point that it was no longer attractive to sell on the way up, I don't know that 6% suddenly is going to be attractive on the way down. So that's where my mind goes around that. We're going to watch the supply and demand teeter-totter and just see where we are. And guys, it's easy to see where that's trending. You know, number of units on the market versus how many days before they go under contract. And you can compare those absorption rates to historical norms. So we're super excited to see what 2024 has in store. I don't think anybody would have predicted that we would start 2024 darn near the same way we started 2023 from an interest rate standpoint. The big difference being that most of the predictors of the future, that could be a comic book or a Marvel movie series, the predictors of the future, because they've been wrong so many times in the last few years. A lot of the predictors are anticipating a bump in appreciation, where this time last year, there were still those naysayers just, almost rooting for a market crash. One of the other big pieces of news coming out of 2023 was the National Association of Realtors and that class action lawsuit and that record judgment. And I don't think anybody really anticipated a guilty verdict. I know I was surprised. And wasn't that kind of eerily spooky that news was released on Halloween? I mean, what a trick and not a treat for the Realtors Association. If one thing comes out of all of this, I think you'll see the industry change its practices in at least the disclosure of real estate commissions. But it's going to be interesting to see how this pans out. I know there's more lawsuits that are piling on, and the appeals process is going to take some time. We're going to watch that. I think that was another big piece of news. But guys, that's where we've been. I'm not sure we know where we're going. Hold on, buckle up. It could be another wild ride. The good news is real estate is resilient. Interest rates are in the sixes, and I think there's a lot of opportunity, whether you're a buyer and seller. And yes, it's still expensive, and yes, it's frustrating. But again, the market has proved that it's pretty resilient. And if you've got money tied up in home ownership, you're likely seeing appreciation. So good on you for pulling the trigger if you did. Guys, you hear the music, you know what that means. That's my cue. We'll be back in a few. Sit tight. On the other side of this very short break, we are going to dive into the data and start taking your questions. Guys, we'll be right back. Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. And we are very, very happy that you're joining us today. We covered a lot of ground in that opening segment. We've already got a couple questions that rolled in. But if you have questions or comments and you want them on the air, just call or text 855-462-7292. That's 855-462-7292. Jen is standing by. Well, she's not standing by. She's already moving pretty quickly back there behind the board. But she is womanning the Anytime hotline, and she will get your questions on the air for you. If you prefer, you can head over to MrMortgageRadio.com. That's MrMortgageRadio.com. Right in the middle of the page. You can't miss it. There is a big orange button that says get your questions on the air. If you click that button, just follow the instructions. Your questions will pop up on our side and Jen will read them on the air for you. But guys, we covered a lot of ground. I guess in summary, rates have moderated. We've seen a threshold of activity around 6% several times in the last 18 months. So logic dictates that there will be demand in the market at these lower interest rates. We're seeing people take advantage of refinancing at these lower rates. And guys, you can use a buy down strategy if you're doing a cash out refi or a debt consolidation refi, or if you were just unlucky enough to have to take an 8% interest rate when you bought your house, and 6.5 or 6 or 5.5 starts to feel more attractive. Now may be a time to consider that, because while rates have pulled back, a lot of people are saying they're going to go even lower. We don't know. Guys, we just don't know. A lot of people missed the rate predictions for the last, 24, certainly 36 months. I think it's safe to say if you pull all the rate predictions up from the end of each of the last 3 years, nobody's gotten it right, and they have a tendency to miss on the more aggressive low side of things. So if you're waiting for a 4.5% or 5% interest rate to refinance, you might miss the opportunity. If you can grab a rate at 6 or buy it down to 5.5, now it may be a great opportunity. And we've got some super, super exciting news coming out in January with some information regarding forward commitments. Guys, builders use forward commitments all the time to offer a lower than market interest rate. And it works just like a futures contract. Remember when Southwest Airlines was offering, $29 and $39 fares? Well, they had gone out and pre-purchased fuel contracts at ridiculously low costs compared to market. And they capitalized on that when everybody else was paying a premium for fuel. They had a lower operational cost and were able to pass that on, and they bought a ton of market share. Well, that's what a lot of the builders have done. They've arranged forward commitments, which is basically a commitment to take down a block of mortgage money. And they're big numbers, guys. We're not talking about, $1 million worth of mortgages. We're talking about several million at a time. And that's why this works really well for some of the big builders. And they'll buy into that forward commitment, and then they can offer a 5.5% interest rate. Well, in January, there's some super exciting news regarding FHA and VA streamline refinances using some forward commitments, getting some ridiculously low interest rates compared to market. Rates people are waiting on, hoping they're going to see sometime in the next year or two. These forward commitments are going to give people access to it. So we're excited. We will probably start talking that up next week as the information is coming together now. But I'm excited about that. And I guess, guys, that goes to the underlying principle that there's opportunity in every market. You just have to look for it. So with all that being said, let's take the opportunity. See what I did there, guys? I kind of weaved it back together. Let's take the opportunity to toss it over to Jen and get some questions on the air. Are you ready, Jen? Okay, let's go ahead.
Doc sent us this. I found a nice condo, but my real estate agent tells me I won't be able to get a mortgage because of issues with the management. Can this be true? It will certainly appraise for more than what I'm paying. Isn't that all that should matter?
Okay, Doc, Man, that's a cool name and a great question. I appreciate this one, brother. So it may be true. It may be the case. And the appraisal has nothing to do with it. It will need to appraise, and it's good that you think it's going to appraise for more than the purchase price because, check that hurdle off the list. But most likely what your agent is referring to is a non-warrantable condo. So during the mortgage application process, there is a association questionnaire, right? It's called a condo questionnaire. And in that questionnaire, the association discloses budgetary items, meeting minutes, future maintenance. The basic idea is to scrutinize how the building is being managed. If it's being managed well, enough money is being collected in the form of dues each month and allocated accordingly to a fiscally sound budget. Monies are being put away for repaving of the parking lot, redoing of the pool, the tennis courts. Every 20 years, you're going to budget for a roof. Whatever the time intervals are and the normal maintenance issues are. And then in addition to that, there are requirements that reserves are in place. A budget reserve not allocated for a specific repair, but a just-in-case fund. And that typical requirement is 10% of the budget. And guys, leading into 2024, there's going to be more scrutiny around this. And a lot of the additional teeth, if you will, in the questionnaire process stems from what happened in Miami-Dade County a few years back in Surfside with the Champlain Tower collapse. That's an example of a very, very poorly run association and poorly maintained building. Lots of deferred maintenance. So the purpose of this classification of warrantable versus non-warrantable is for the lender to determine the risk associated with the loan based on those items. Because if your patio is falling off, your balcony is falling off, you're more likely to walk away and they're going to have to foreclose. They want a safe, sound, well-maintained asset that they're leaning. So all of that being said, a warrantable condo has access to more funding. You can get lower down payments, lower interest rates, a wider variety of loan programs. Non-warrantable in most cases is still able to access mortgage money, funding, but it's going to require a larger down payment and a higher interest rate. Because listen, folks, equity and interest mitigate risk in most of the cases when it comes to the lender's standpoint, right? If there's more equity in your property and you're paying a higher interest rate, that'll mitigate risk. So a non-warrantable condo is typically fundable, assuming you can put a larger down payment down and are willing to pay a higher interest rate. So great question, Doc. I hope that helped. If you need to deep dive it and you want me to run a specific condo association or condo project through the database to see if it's already approved as warrantable, I'm happy to do that for you. But that's my guess as to what your agent is talking about. But hey, I greatly appreciate this question. It's a good one and it confuses a lot of people. Hey guys, you hear the music? You know what that means? That is my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. And you heard the man. If you have questions or comments, just call or text 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. And Jen is womanning the hotline and ready to get your questions on the air. Or if you prefer, just head over to MrMortgageRadio.com. That's MrMortgageRadio.com. And right in the middle of the page is a big orange button that says Get Your Questions on the Air. Just click that button, follow the instructions, and your questions will pop up here on our end, and Jen will read them on the air for you. Hey, but speaking of your questions, and Jen, I know we've got a few back there, so let me throw it over to her right now for another question. Hey, Jen, go ahead.
Becky sent this text. We're buying my mother's house, and she's offering it to us for about 75% of what it should appraise for. Since the price is so low, can we borrow 100% of the price?
Hey, Becky, this is a great question. And the answer is no, but also yes. And what I mean by that is there is definitely a way to make this work, but borrowing 100% of the purchase price is not the way that you want to do it for a variety of reasons. The biggest one is there's not a 100% loan that's out there. But here's the really cool thing. You mentioned you're buying it from your mother. So she could sell you the property and gift you the equity. Instead of discounting the price, just give it to you as a gift of equity. So let me illustrate, and I'm going to use round numbers because I know there are no $100,000 homes out there anymore, unless your mom lives in fantasy land. So let's say mom's place is worth $100,000, and you mentioned she's going to sell it to you for 75% of the value, which means you're going to buy it for $75,000. Well, you could write the purchase contract for $100,000, and mom could gift you $25,000 for your down payment and your closing costs. So you could take a $75,000 loan and essentially buy the property with no money out of pocket. Now, the math might be a little bit different depending on your particular circumstance, but you see where I'm going with this. A gift of equity is the easy way to accomplish what you're trying to here by essentially borrowing 100% of the purchase price. Assuming the property is going to appraise for 100 and mom will take 75, the gift of equity strategy will work. You're borrowing 80% or less, so you don't have to carry mortgage insurance. Plus, you might be able to swing the math so there's zero money out of pocket with that percentage of equity being gifted. Guys, we do this one all the time. It's not uncommon for parents to sell the property to the kids and not need all of that equity. The goal was to give it to the kids anyway, but mom might need some money to go buy a condo or a smaller place, so she could still walk away with some money in this scenario. So great question. Gift of equity. If anybody has any questions or if you need more information, please reach out. I love talking about this. This is a great way to pass that equity on generation to generation. So I appreciate the question. Hey, Jen, throw me another.
This one doesn't have a name. My landlord just sold my house, and the new landlord wants to evict me on paper in exchange for putting the electric in his name and paying the bill. He says this will make his taxes lower. I know this can't be legal. What do you think he's up to?
Ooh.
I have more than a year left on my lease.
Okay, this is interesting. I think I follow what's going on. So when you say evict on paper, they're not really evicting you, but the eviction on paper allows them to take the electric out of your name and put it in their name. Okay, here's what I think is happening. I think your landlord, your new landlord, is committing occupancy fraud. If I'm being 100% honest, I might be wrong. I hope I'm wrong, but it sounds to me like you've got a lease in place. He wants to put the electric in his name because if he can show a utility in his name, he can put homestead exemption on the property, file homestead on the property, and get a lower tax base. But if he bought the property using a primary residence mortgage, this one's interesting. I would love to talk to you off the air about this just to get a little more information. But my gut reaction is occupancy fraud, meaning he wants to put the homestead on the property to lower the taxes and then cap the tax increase each year based on whichever state you're in, the maximum allowable increase for a homesteaded property. And in order to file, for example, in Florida, where we're based out of, where we're headquartered, you have to produce a utility bill and your closing paperwork dated prior to December 31st to show that you own and now occupy that property as owner occupied. That's where my gut goes with this. I might be wrong. I hope I'm wrong. But guys, occupancy fraud is a real thing. And a lot of people scoff at it like it's not a big deal. Well, hey, it's a Class C felony. I mean, it can cost you up to $5 million and I believe 10 years in prison. I'll have to look that up. But occupancy fraud primarily in the past was around this scenario. Buying a property, saying it's going to be my primary residence and never intending on living in it, just renting it out. And I'm doing that so that I can get a lower down payment and a lower interest rate. That's occupancy fraud. And historically, that was the primary type of occupancy fraud. Well, with the advent of the DSCR loans, the landlord loan, which requires no income documentation from the borrower, you're just using the projected income for a rental property. A lot of people tried to use the landlord loan as a no income verification loan, buy a property, sign the affidavit in the closing documents that this is going to be a rental property, and then move into it as your primary. Well, guys, that's also occupancy fraud. I would certainly not allow them to evict you on paper. I would certainly not take any of the utilities out of your name because you don't want to be a party to this. And you certainly don't want to put yourself in a position where there's an eviction on your record because that affects your credit. That affects the likelihood of you being able to rent in the future. So this one I would stay way away from. You might want to even consult an attorney. And if you're renting a property that has been sold to another landlord, to another investor, there should have been an estoppel letter at closing. You would have had to sign it. And that estoppel letter spells out everything: your lease term, your monthly rent, who you were paying your rent to. They attest that you're in good standing. You attest that there are no issues on the landlord side. Nothing changes. Your lease doesn't change. Your rent amount doesn't change. The deposit changes hands from landlord to landlord, but it's still yours. So that estoppel letter should have spelled all of that out at closing, and that protects you as well as the tenant. So this one definitely smells fishy. I would stay way away from it. And if you want to have a deep discussion off the air about it, just call me. I'll be happy to help any way I can. And who knows, maybe I can refer you to an attorney who you can at least have in your back pocket just in case this gets weird. But thanks so much for the question. But hey guys, you hear the music, you know what that means? That is my cue. We'll be back in a few. Sit tight on the other side of this very short break. We'll be back with more of the Mr. Mortgage Show. Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. If you have questions or comments, just call or text 855-462-7292. That's 855-462-7292. That is the Anytime Hotline, and Jen is womaning the hotline, and she'll get your questions on the air. Or you could head over to MrMortgageRadio.com. That's MrMortgageRadio.com. You can't miss that big orange button in the middle of the screen that says get your questions on the air. Just click the button, follow the instructions, and Jen will read your question on the air for you. Hey, but speaking of Jen and your questions, I know we've got some back there, so let's keep this rolling. Hey, Jen, do you have another question?
Sandra sent this one in. I just want to say thanks. I emailed in last week about my insurance being canceled. Christian helped me find a policy I can afford, still more than I wanted to pay, but much better than the other options. Thank you both.
Hey, Sandra, thank you for following up. I am super, super excited to hear that it all worked out. And if I remember correctly, you were up against maybe force-placed insurance, if memory serves me correctly. And guys, you never want to go force-placed if you can avoid it. So in this case, I'm glad that it worked out, because anything that starts with forced never seems to be an enjoyable experience. And those lender force-placed insurance policies are super, super expensive. So thanks again, Sandra. Christian and his team are awesome, and I'm glad they were able to help. Hey, Jen, do you have another question ready? Go ahead.
Cassie wants to know, is there a special refinance loan for first-time buyers with an FHA mortgage? I think I remember you talking about this one before.
Hey, Cassie, great question. I believe you are referring to the FHA Streamline refi. And yes, it is a super special loan program, but you don't have to be a first-time home buyer. And guys, a lot of people don't realize it, but FHA is not only for first-time buyers. You can have back-to-back FHA loans. They're a great loan program for just about anybody. So, but back to Cassie's question. To do a rate reduction streamline refi for either FHA or VA, interestingly enough. And you heard me kind of hint about some of the forward commitment money that we have available in January. Well, guys, it's specific to the FHA Streamline and VA interest rate reduction loan program, which is the VA version of the Streamline refi. Guys, listen to this. In most cases, we're able to do these refinances with no verification of employment, no hard credit inquiry. That's right. We can do these in most instances with just a soft credit inquiry, no asset verification, and no appraisal. There's minimal documentation and minimal requirements to do an interest rate reduction loan on the VA side or the streamline rate reduction on the FHA side. Guys, these are exciting loan programs. And if you're one of those people that bought with an FHA loan in the low 8s or high 7s, we need to talk, because this forward commitment money in January is going to be super affordable. And guys, if you bought your house with a temporary buy down, like a 3-2-1 or 2-1 buy down, you might want to jump on the bandwagon and consider a refi, because whatever's left over in that buy down money, you can take right off your principal. That's right. It's your money. It can reduce the amount that you need to refi. So really interesting times now that rates have pulled back. Now might be worth starting that conversation. So anyway, back to Cassie's question. Yes, there is a streamlined rate reduction refi program for FHA. And the good news is very light documentation, and you do not have to be a first-time buyer. Hey, Jen, toss me another question.
Alex sent us this one. I was watching TikTok over Christmas and saw several people talking about a new FHA 100% program for first-time buyers. Can you explain how this works?
Hey, you weren't the only one looking at TikTok over the holidays. Man, there's some interesting and some frightening things on there. I've learned some new recipes and watched some people build some fascinating structures. I get the addiction to TikTok. That algorithm is really fascinating. But hey, to answer your question, there is not a 100% FHA loan. What a lot of people call this quote unquote 100% loan is actually a down payment assistance program coupled with an FHA loan, because most DPA, down payment assistance programs, work with FHA. So you can get a 3.5% grant and a 96.5% mortgage. So it's 96.5% of the purchase price is the FHA mortgage, and the remaining 3.5% is a grant. Now, some of these grants are just like a gift. You don't have to pay them back. Others require a monthly payment, and some require repayment at sale or refinance. So there's a variety of different down payment assistance programs that work with FHA to get you essentially 100% financing, but it's not one FHA program at 100%. And one of the really interesting things about using a DPA program coupled with an FHA loan is you can still ask for, in most cases, up to 6% for a seller contribution. So you're talking about being able to buy a property with very, very little money out of pocket if you get a seller contribution and a grant and an FHA loan. But it's not a true quote unquote 100% FHA loan. It's FHA plus a down payment assistance program. I hope that helps. That was a great question. And I've seen a variety of those bouncing around social media as well, so I understand the confusion. But guys, if you're confused about any of this, call us, text us, visit MrMortgageRadio.com, set up a call. I'll jump on the phone with you and help any way that I can. Hey, Jen, let's get another question in if we can. Go ahead.
This one is from Karen. How quickly from start to finish does a normal mortgage take? We found a house and the seller says if we can close in 2 weeks, they'll take our offer. Is there any way this can happen?
Hey, Karen, this is a great question. Now, you're certainly not talking about a normal timeline because normally you're looking at about 30 days. But to answer your question, this can happen in 14 or 15 days, but it's really going to be on you. How quickly can you get all of your documentation together and submitted? So just to let you know, our shortest start to finish in the last, year or so was 8 days. But that was somebody that was ready to go. They had gotten to a point that they were denied with another lender, so they came over with a complete documentation package. All we had to do was get the property appraised and we were ready to go. So yes, you can do it. I would be careful how you write the contract so your deposit is not in jeopardy if you don't close in time, but you will have to be ready to run because we say it all the time. I drive the bus, but your foot is on the accelerator. So it's up to you how fast we go. I'll keep us on track, but it's up to you how fast this bus goes. And what I mean by that is if you can get your lender all of the documentation right up front and limit the back and forths, they should be able to get it done. I know we can. If you haven't picked out a lender, I'd love to talk to you about it. Heck, let's bang one out in 14 days. We can do it. But I appreciate the question and good luck and congratulations on finding a place worth fighting for because you can make this happen. You just have to be ready. Hey, Jen, throw me another question.
Ernesto has this question. I'm going to use my Christmas bonus to pay off my credit cards. Once I close them, how long will it take for my credit score to go up?
Hey, Ernesto, this is a great question. You do not want to close your credit cards out once you pay them off. Don't close them out because length of credit is a scoring factor and also the amount of credit versus the available balance. And what I mean by that is if you've got a $5,000 credit card and you have $2,500 on it, you still have 50% usage. So if you have one of those and a $5,000 card that you just paid off, you are at 25% credit utilized, right? Because you have two $5,000 cards. That's a great scoring criteria. And length of credit. But if you close that $5,000 card out that you just paid off, now you're at 50% usage. I can talk to you in detail about this, but don't close them out. Pay them off, but don't close them out. That's a common misconception. It can actually lower your score, which is the last thing you want to do at this point. Hey guys, you hear the music? You know what that means? We have wrapped up another week at the Mr. Mortgage Show, the last week of the year. Guys, we've had a blast with you this year. Thank you for tuning in each week. Thank you for supporting the stations that play the show. We're super excited that you're part of the Mr. Mortgage family. If you need us when we're not on the air, head over to MrMortgageRadio.com. That's MrMortgageRadio.com. Otherwise, Jen and I will be back next week right here. Same time, same station. Have an awesome, awesome week. A happy new year. Be safe, and we'll see you next time.
That's a wrap. Join Mark Eitel next week for more thrilling, edge-of-your-seat discussions about real estate and mortgages right here on The Mr. Mortgage Show.